Hello everybody, we're talking about the top 5 mistakes to avoid when using a deferred sales trust. It's so important that when you are planning your exit plan and you have huge capital gains taxes, that you are avoiding these top mistakes. And so mistake number 1, choosing the wrong 1031 qualified intermediary. Every single week, I think I get a call from someone who went with a qualified intermediary who doesn't know, like, or trust the deferred sales trust. Guess what? A lot of qualified intermediaries don't want you to know about the deferred sales trust, or they just don't know, and that's okay. They are specialists in their areas of 1031 exchanges, but they're not specialists in the deferred sales trust. So what's the action that you can take today? Well, you can connect with us here at Capital Gains Tax Solutions and work with our preferred strategic alliance to have a full 1031 exchange plan, as well have that backup plan with the deferred sales trust in case your 1031 fails. Mistake number 2 that a lot of people make: poor planning as it pertains to the timing of when they set up the deferred sales trust. So let's imagine you're selling a business, cryptocurrency, stock, or anything else that's not subject to a 1031 exchange, such as a primary home as well. Guess what? You want to make sure you set up the trust with proper planning. What that means is that you're setting it up prior to the removal of all contingencies. If the buyer removes all contingencies, it's too late. You are subject to the capital gains tax known as constructive receipt. And so with proper planning, you can set up the deferred sales trust at no cost, no obligation with our company here at Capital Gains Tax Solutions. Get everything in line and ready to go so that you don't run out of time. And so that is mistake number 2, is not setting up in proper timing. Mistake number 3, poor asset selection or not having a plan for where and how the funds are going to be invested post-close. The last thing you want to do is have money sitting idly. Money sitting idly is sitting in a bank not making a lot of interest. You want money earning interest immediately or have a place to invest the funds immediately. We call that sleepy capital, which not working for you. We want active capital that's working. What are some of the investment selections? Well, understanding what assets you can invest in are very important. So number 1, you can invest into real estate. That's my favorite. One of the groups that I work with that's one of the best at what they do is called DLP Capital. I'm going to tell you about a live case study right now that we've done with them. And they have a DLP lending fund that pays about 10%. They're lending to those who are investing in and need some money for multifamily investments. And so on this particular fund, it pays about 10% on average per year. So if you were to put about $1 million in there, it's going to be about $100,000 of cash flow. And what's unique about that is it pays about every 30 days. It pays the interest that it's accruing and building up inside of this fund, as well as you can exit within a short period of time as well. We call this semi-liquid investments. Not subject to the stock market, which is the next part that you can invest into. But a lot of my real estate clients love real estate. They also have multifamily funds where you can be a passive investor to invest into these deals. Now, what if you're an active investor and you say, hey, I want to do this myself? Great news, the Deferred Sales Trust, you can partner with the trust and the trust can invest with you actively in a deal, right? So you can build, you can lend, you can invest with other partners. In fact, we had a client out of San Diego. They sold a $13 million car wash, and their biggest thing is buying land and developing businesses and developing car washes. And the Deferred Sales Trust gives them that opportunity to do just that. What other investments can you invest in? Well, you can also go into the stock market. You can also go into T-bills. You can also go into money market accounts. You can go into just about any asset that you would like to go into, as long as it's investment purpose or business purpose. And I think the ability to have liquidity is one reason a lot of my clients are considering and are using the stock market, because they're buying at a little bit of a discount if the market might be down a little bit. And they're waiting for investment real estate to shift, which leads into the biggest, third biggest mistake to avoid when using a deferred sales trust, which is inadequate planning for estate planning purposes, okay? One of the biggest challenges that a lot of our clients face is estate tax. They're above certain exclusion amounts, and these exclusion amounts are subject to a 40% death tax. So you wanna make sure that you understand what problem you're solving for. And it's a simple equation. Number 1, what's your total net worth? Number 2, how much of that net worth is inside of your taxable estate? And number 3, what is your plan to remove those funds outside of your taxable estate? Once you understand those 3 parts of the equation, you can start to dial in exactly how to exit using what's called the DST plus. without any life insurance, without any gifting, and without having to have a lot of children to also gift it to. You can remove the funds outside your taxable estate, also without any charity required as well. And this is really kind of amazing, because let's imagine you had a $100 million taxable estate, all of it inside, let's say, multifamily or a business, and you were to sell that asset tomorrow. Well, we could sell that to the DST Plus in the same day and essentially move all of the funds outside of your taxable estate, which would eliminate that 40% death tax. And so without proper planning or understanding what you're solving for, a lot of people can make the mistake of not using the DST Plus to remove funds outside their taxable estate. The other part I'll mention too is this: if you're doing a DST 1.0, you want to make sure you set up your living trust and you are funding that living trust with the asset. In this scenario on the DST 1.0, it would be the promissory note. That is the asset that goes inside of your living trust. And that way your children can step into your shoes and you can make sure that the income is going to where you want it to go. And so that's just mistake number 3 to consider. What's the mistake number 4 you want to make sure you avoid is poorly structuring the payouts. You want to make sure that the payouts are based upon your needs and your wants. It's never a wrong answer for how you receive the funds back. You pay tax as you receive it. But I have some clients at times will set up too quickly too much payout. And when that happens, they end up receiving income that otherwise they just pay tax on and then have a great place to invest the funds, versus just keeping it in the trust for a period of time and letting it compound and build. It's sort of like an IRA. If you have an IRA now, part of the beauty of an IRA is it's deferring the income tax and the capital gains tax, and it's growing at a good pace. And so making sure we properly structure the payout based upon your needs and your wants. Now on a DST 1.0, a lot of our structure payouts are based upon a 10-year term with the balloon payment due in 10, but payments starting in year 1, 2, or 3, interest payments or partial interest payments. And so let's just imagine it was a $1 million promissory note at 8%. It's an $80,000 interest that's accruing. You may set that up with $40,000 to pay out in year 1, the other $40,000 to accrue and build up. You might even delay that for a couple years and let the full 8% accrue year 1, year 2, and in year 3, you start a partial interest payment. And so understanding the nuances of that and really dialing in on your needs and your wants is so important to make sure that you're not taking too much that you don't want to receive and just to pay tax on when it could have been deferred. So we work with you to structure that and to strategize that. Also knowing that DST 1.0, let's imagine you did set it up and it's not exactly what you had hoped for. It can be adjusted by working with us here at Capital Gains Tax Solutions to properly structure that even better. Which leads into the last mistake that we see people making, and this has to do with either ignoring the regulatory compliance and or just the overall legality of the trust, and maybe trying to go outside the lines. What does that look like? Well, wanting to maybe invest the funds into a primary home, or wanting to invest the funds into something that has too much risk, right? Not diversifying the trust enough. And the overall, we want to make sure that we're matching and mirroring as much as possible the risk tolerance with the promissory note, and we are working together, us as a trustee with you as the note holder and the tax attorney who created this, to make sure everything is coinciding with what the structure has been made for. And so those are just 5 things to avoid when using a deferred sales trust. Hey, we would love the opportunity to connect with you even more. If you're a client, thank you so much for watching this. If you're a potential client, we want to walk you through what the deferred sales trust can mean for you. Just go to capitalgainstaxsolutions.com, subscribe to our YouTube channel, and check out our new book, Building a Capital Gains Tax Exit Plan, on Amazon. Thanks so much for watching this video, and we'll talk to you again real soon.